Investing in bonds isn't tricky. Let's explore the different types of bonds in the U.S. market and what you need to know about each. Today we're breaking down the different types of bonds in the U.S. bond market. Whether you're a seasoned investor or just starting out, understanding these bonds is crucial for making informed investment decisions. Let's get started. As always, this video is for informational and educational purposes only. It should not be considered financial advice. Always discuss any financial decisions with your financial advisor to determine the best strategy for your individual needs and goals. Before we jump into the specifics, let's quickly recap what a bond is. A bond is a loan you give to a government, municipality, or corporation in exchange for periodic interest payments and the return of your principal's face value at maturity. Bonds are a key component of a balanced investment portfolio because they can provide steady income and stability. We're going to simplify our deep dive by breaking our types of bonds into two categories. First, we'll focus on bond types based on the issuer, and then we'll conclude with bond types that you may hear a lot mentioned in the media, which are more related to their structure or their features. Let's dig in. First up, we'll start with U.S. government bonds. These are considered to be some of the safest bonds you can buy. One way to think of it, if the U.S. government defaults, in other words, is unable to pay its debts on its bonds, we probably have a lot more to worry about than our bond interest payments. It may sound a little extreme, but it pretty much sums it up. There are three different structures issued by the United States Treasury. We'll start with the shortest maturity, and we'll work our way out to the longest. First up is Treasury bills, or T-bills. They're the shortest securities with maturities of a few days up to 1 year. They do not pay regular coupon payments like most bonds. Instead, they are sold at a discount to their face value and you receive face value at maturity. For example, you may pay $980 for a T-bill that pays off in 6 months and receive the $1,000 face value at maturity. The difference between the $980 and the $1,000, that's your interest. Beginners should note that T-bills are highly liquid and virtually risk-free, making them an excellent choice for short-term investment needs or a safe place to park cash. Next up, Treasury notes, or T-notes, are medium-term securities with maturities of 2, 3, 5, 7, and 10 years. They also offer the safety of government backing and pay interest every 6 months. For beginners, T-notes are a good option for a balance between safety and return. Last, we have what are actually called Treasury bonds. They are long-term debt securities issued by the U.S. government with 20 and 30-year maturities. They are considered one of the safest investments because they are backed by the full faith and credit of the U.S. government. One often not discussed aspect of Treasury bonds is their non-callable nature. With a lot of other fixed income securities, we typically see some sort of call feature where the bonds can be paid off early. Not so with Treasury bonds. That means you can lock in those interest payments for 10, 20, even 30 years and not worry about them being paid off early. Beginners should know that these bonds offer lower yields but high security. Next up are agency bonds. They are issued by government-sponsored entities like Fannie Mae and Freddie Mac, to name a few. They are not backed by the full faith and credit of the U.S. government, but they are considered quite safe due to their government affiliation. Beginners should know they can offer higher yields than treasuries. One significant difference, though, between agencies and treasuries is the callability. The majority of federal agency bonds are issued may have significantly higher yields, but that is because the bond can be paid off early if interest rates decline. Next up, probably one of my favorites, and the type of bond I spent the most time trading professionally, is municipal bonds, or munis. They are issued by state and local governments like counties, cities, fire district, turnpike authorities, just to name a few, to fund public projects like schools, hospitals, highways. The interest earned is often exempt from federal tax and sometimes from state and local taxes as well. This tax advantage can be particularly beneficial for investors in higher tax brackets, but even people in the middle tax brackets can realize some serious savings. Additionally, munis are generally considered safer than corporate bonds, although they carry some risk depending on the financial health of the issuing municipality. Next up is corporate bonds. Corporate bonds are issued by companies to raise capital for expansion, and other projects. They generally offer higher yields than government bonds, but come with higher risk. Beginners should carefully assess the issuing company's credit rating to gauge the risk level. For those of you who are well versed in stock market investing, corporate bond investing can require the same sort of research as stocks, because a lot of the risks can be quite similar. Some of the issuers you will see in the corporate bond market are Apple, Ford, and Berkshire Hathaway of Warren Buffett fame. One very important distinction between buying a stock of a company and buying a bond for the same company: in the event the company goes bankrupt, the bond investors will get paid first before stock investors. In fact, stock investors only get paid if bond investors have been completely paid everything they are owed. The final issuer type we'll discuss are collateralized mortgage obligations, or CMOs. These are complex securities backed by pools of mortgage loans. If you've ever taken out a mortgage on a home, your loan may have been added to a pool of other mortgages and sold as a diversified package of mortgages for investors. They provide monthly payments and can vary in terms of risk and return. I know some folks who really love investing in CMOs, but I also know some others who completely avoid them, primarily because the interest and principal payments can be accelerated so that you may receive a larger portion of your principal back when interest rates are lower. That leaves you with more money to invest at lower rates. Beginners really should be cautious and understand the structure and risks before investing. As always, do not invest in something you do not understand. There are too many good investments out there to take unnecessary risks. This concludes our types of bonds that are related to who issues them. Now we'll move into types of bonds that have more to do with the risk and structure. But before we do that, if you're finding value in this video, please hit the like button so that others will know the video is worth their time. You may hear some of these terms in the financial news reporting you see on television. First up is high yield bonds, also known as junk bonds. High yield bonds have lower credit ratings and higher default risks, but offer higher interest rates. They can be attractive for investors looking for higher returns, but it's so important to understand the increased risk involved. This is not where I would suggest beginners start their bond investment journey. Junk bonds tend to fit better in a large portfolio of high quality bonds to possibly take on a little more risk than usual for slightly higher returns. Again, file junk bonds under do not invest in things you do not understand. Next, we have zero coupon bonds. Zero coupon bonds do not pay periodic interest, thus the name zero coupon. Instead, they are sold at a deep discount to the face value and mature at par. Beginners should understand that these bonds can provide significant lump sum returns at maturity, but do not offer regular income. Our next type of bond is convertible bonds, and they can be converted into a predetermined number of the issuing company's stock shares. They offer the potential for capital appreciation if the company's stock price rises. Beginners should know that convertibles combine features of both bonds and stocks, providing both income and growth potential. Now that you know the different types of bonds, how do you choose the right one for your portfolio? Consider your investment goals, risk tolerances, cash flow needs, time horizons. Diversification is key, so don't hesitate to mix in different types of bonds to balance risk and return. To recap, we've covered treasury bonds, T-notes, T-bills, muni bonds, corporate bonds, high-yield bonds, agency bonds, collateralized mortgage obligations, zero coupon bonds, and convertible bonds. Each type has its unique features and risks. Understanding these can help you make more informed investment decisions. If you found this video helpful, please like, comment, and subscribe. It really does help us out. Check out the videos appearing on your screen now for more in-depth guides on investing. Thank you so much for watching. The final issue or type we'll discuss are collateralized mortgage obligations. Wow, that's easy for you to say.